Is your mortgage coming up for renewal soon? Great, then this video is for you. This video will explain how to best take advantage of your upcoming mortgage renewal. See, renewal time provides a great opportunity to make changes to your mortgage without paying a penalty, as typically you would have to during the middle of your mortgage term if you needed to or wanted to make changes. So what changes might you want to make to your mortgage? I'm glad you asked. We're going to look at 3 different examples, starting with Brian and Stephanie. 5 years ago, they purchased their home for $500,000 with $100,000 down payment. The mortgage of $400,000 was amortized over 25 years, and now, 5 years later, it has a balance of $338,000. Their mortgage payment is currently $1,792 per month. Their home has gone up in value over the past 5 years, from $500,000 to now $625,000. This is excellent because between their home value increasing and their mortgage balance decreasing, they now have $287,000 of home equity built up in their home. However, in that time, they've also amassed a wee bit of debt. They've been carrying $30,000 of debt between multiple credit cards and unsecured lines of credit. This type of debt is considered to be bad debt, and combined, they're currently making minimum payments of $900 every month. Brian and Stephanie decide that for their mortgage renewal, they're going to increase their mortgage by $30,000 to pay off that bad debt. Their new mortgage is $368,000. They decide to choose a 30-year amortization for the new mortgage instead of a 25-year or a 20-year amortization, because they want to keep their payment low, and they also know that they can use their prepayment privileges to pay off their mortgage faster anyways. Their new mortgage has payments of $1,452 per month. Now that $30,000 of debt has been paid off, their monthly cash flow has improved by $1,240. That's $14,880 per year of improved cash flow. Listen, for Brian and Stephanie, being debt-free and especially mortgage-free is very important to them. So they decide that from the $14,880 yearly cash flow improvement, they're going to put $10,000 of that money towards their mortgage principal every year by using their prepayment privileges. If they continue to do this at this rate, after 15 years, their mortgage will be completely paid off. Plus, they feel especially comfortable knowing that if times were tough all of a sudden, that at least their required mortgage payment is a nice, low, and manageable one. So let's look at another example with their neighbors next door, because maybe you don't have debt right now. See, Josh and Sarah are in a bit of a different situation. They purchased their home right around the same time, and they spent $500,000 as well, and they also put down $100,000. Their home now too is worth $625,000 after the 5 years has passed, and they also have a mortgage balance of $338,000. Very similar situation, almost exactly the same, including their mortgage payments are also $1,792 per month. However, this couple does not have any debt. So what should they do? Should they do anything? Well, they love where they live, but they feel that their home's just getting a little bit outdated and they need some improvements. Recently, they've been seeing their neighbors having renovations done, which got them interested. They've been seeing people redoing their kitchens, redoing bathrooms, finishing their basements, or replacing windows or the roof. For Josh and Sarah, it's important that their home be one of the best and highest value homes on the street. So with their mortgage renewal coming up, they decide to increase their mortgage by $50,000 to do some of the home improvements that they've just been craving to do. For their new mortgage of $388,000, they decide to stick with a 25-year amortization, and the payments on the new mortgage are $1,738 per month, so not much different than before. Fast forward 6 months and the renovations are complete. Their home is now worth $675,000. So it's gone up in value by just about as much as they put into it. They're very happy with how things have turned out. Their home has increased in value significantly, plus they get to enjoy the updated home, the brand new kitchen, bathroom, ensuite, you name it. Josh and Sarah also want to pay their mortgage off fast, so they too use their mortgage prepayment privileges to chip away at that mortgage principal, each time lowering their amortization slightly down and down further. Across the street, their neighbor John also has a mortgage renewal coming up. He has no debt and he does not want any extra money for any reason. He decides to leave his mortgage just as it is. He discovers that the rate his current lender is offering to renew him at is not as good as what he could get by switching to another lender. He decides to transfer his mortgage. The new lender picks up the cost for him to switch, and everything else stays the same. John is happy because he's got a slightly lower rate now than he had before, which has made his payments slightly lower as well. So when does it make sense to make changes to your mortgage, and when does it not make sense? Well, when you make changes at renewal time, it is done as a new mortgage. The new mortgage pays out the original mortgage plus gives you the money that you want or need to pay off those debts, or to do the home renovations, or to use towards down payments on purchasing an investment property, etc. So even though you do avoid paying a penalty by timing it with your upcoming renewal, there are still costs to put the new mortgage in place. These costs are a discharge fee of approximately $300, an appraisal fee of approximately $300, and legal fees of either $830 approximately if using a closing company, or approximately $1,300 if using your lawyer. These costs are added directly into the mortgage, so they do not need to come out of pocket. Whether it makes sense or not to make changes to your mortgage at renewal time will come down to your situation. See, if you only need a few $1,000s, then it probably does not make sense to go through this trouble just for a few $1,000s. Now, if you are carrying a lot of high interest debt, then in that case, it would make sense. Or if using the money for various home improvements and the value of your home will be increased by much more than the cost to do those home improvements, well then it probably does make sense. If you want to know specifically about yourself, whether it makes sense for you financially, speak to us. Tell us about your situation and tell us about your goals, and we'll let you know if what you're thinking of doing does make financial sense or not, and guide you in the right direction, as well as give you the numbers and the information that you need to make a confident, informed decision. So what would the process even be if you do decide to make some changes to your mortgage at your upcoming renewal? The mortgage process will be a lot like it was when you first got your original mortgage. We'll start by updating the information we have for you from previously, as more often than not, things have changed since we originally put your mortgage in place. Or if we have not worked together yet, we'll gather your information from you. This can be easily done over the phone in 5 to 10 minutes, so it's not a big deal. And we can also send you an email with the information that we need. So what documents will be needed? Typically, we'll need a most recent notice of assessment and T4, as well as a pay stub and a letter of employment. If you receive overtime, bonus, or commission income, then we'll need the past 2 years of T4s and notice of assessments. If you make self-employed income, we will need 2 years of full T1 generals and 2 years of notice of assessments. And we'll also need a mortgage statement from your current mortgage lender. Don't worry, we'll tell you exactly what documents we need from you. And getting those documents to us is easy. You can drop them off in person at our office. You can send them by email or fax. You can get the online version and send that over to us. And you can even use your phone to take a picture and send that over to us, just like that. So if you have a mortgage renewal coming up and you would like to make changes to your mortgage, you do have a limited amount of time to take action. So take action now by picking up the phone and giving us a call, send us an email, or fill out the form on this page to start the process today.